Good morning and welcome to today's webcast, Economic and Real Estate Market Outlook in 2025 and Beyond. Before we begin, I'm going to play a brief housekeeping video.
Welcome and thanks for joining us. Our webcasts are designed to help elevate your business performance. Transform your future for the better with advisory solutions tailored to your vision and supported by our collective technical resources. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget. You can ask our presenter questions during the webcast by typing a question in the Q&A window and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% or 3 of the 4 polling questions, which we'll ask throughout today's presentation. Polling questions will appear within the slide window. To participate in the polls, please click on your answer and be sure to hit the Submit button to record your response. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry, if you can't download your CPE certificate today, we'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our group CPE attendance sheet to receive credit. The attendance sheet is available in our slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit only can be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Before we get started, I wanted to share our big news that Moss Adams and Baker Tilly have joined forces to redefine accounting, tax, and advisory services for the middle market. It's really exciting, and you can read more about it on our website via the link in the slide deck and handouts widget. With that, I'm pleased to introduce today's moderator, Kelvin Tetz, Managing Principal of Real Estate at Baker Tilly. Kelvin has practiced public accounting since 1998. He provides accounting, assurance, and advisory services to the real estate and hospitality industries. And with that, I'll turn it over to Kelvin to get us started.
Thank you, Cole, and thank you again to our audience for joining us today. As we look ahead, understanding the economic landscape and how it intersects with real estate industry is more important than ever. With shifting interest rates, changing tax laws, and ongoing market uncertainty, staying informed is essential to navigating the opportunities and challenges ahead. Today's presentation will provide key insights to help you make more informed decisions and better position your business for success in the coming year. I'd also like to remind everyone to please use the Q&A. There will be time at the end for some questions and answers by Ken. So please type in your questions as they come up throughout the presentation, and we'll get to those towards the end. I'd like to introduce you to today's presenter, Ken Rosen. Ken is chairman of Rosen Consulting Group, a real estate market research firm, chairman of the Fisher Center for Real Estate and Urban Economics, and professor emeritus and California State Chair of Real Estate and Urban Economics at the Haas School of Business at the University of California, Berkeley. Ken is a trustee of the Urban Land Institute and a member of the board of directors of several nonprofit and for-profit entities that deal with real estate finance and development. With that, I will hand it over to Ken.
Thank you, Kelvin. We're going to start with some questions. So Cole, maybe you want to talk about this, and then we'll get into the presentation.
Thanks, Ken. For our first CPE polling question, we have, what is your main business affiliation? A, real estate, finance, investment, or development. B, financial services. C, professional services. Or D, other. And as a reminder, you have about 15 to 20 seconds to record your response via the polling question. To participate, please click the button next to the answer you choose and hit submit. Give it about 5 more seconds. Question is now closed. Back to you, Ken.
Okay, so you can see from this that the vast majority of people are in the real estate, finance, investment, development business, obviously some financial services, and of course, professional services as well. So what I'm going to do today is really give you an overview of where the economy is going. And I have to start with the fact that we have a new president that took office in January, and a number of major proposal changes from where we were in terms of economic policy. So first, it's worth saying we have these wars going on. Obviously, the Israeli, Iran, and the U.S. bombing happened in the last week as a ceasefire for now. So the markets are rallying, but we still have the ongoing war with Ukraine and Russia. Very unusual to have these large-scale activities taking place, and the financial markets are taking it in stride. Stock market has recovered substantially from both of these events. But keep in mind that uncertainty is still there, I think, on both sides. Specific policies that have been proposed, you can see I've got 5 categories here, so let me talk about each of them. The one that's about to hit in a big way is the proposal by the administration to do a tariff plan on all countries. Right now, we have a 10% tariff plan on all goods coming into the country. And on July 9th, we're supposed to get the reveal on the rest of the tariff plan. It might be postponed again. The reason the administration is doing that is they like to cut the amount of imports coming into the country, make them more expensive, and get our trade balance, which is minus about $1 trillion down as a result. They already have put a tariff of 25% on auto imports and a 50% tariff on steel and aluminum imports. And so the negotiations going on with many countries are supposedly taking place. We may hear more about them in the next 2 weeks, but it is a big deal because it does raise, we think, prices in the U.S. The tariff are going to be passed on to the consumer in most cases. I know that that's not what the administration says, but almost all the literature shows that the big chunk of these tariffs have to be passed on to the consumer and won't be eaten by the exporters, but we'll have to wait and see. The other big component of plans is a dramatic change in our policy for immigration. As you know, in the last 10 years, immigration has accounted for about 45% of our population growth, 1.2 million legal immigrants a year. And then in the last 3 years, we had a big asylum program. And so we had a surge of about 5 million extra immigrants come in under protection agreements from Venezuela, Haiti, Ukraine, places like that. That's all been suspended now by the Trump administration. And we're trying to prevent the immigration that is not legal. And immigrants who are here already are being deported. And we've seen some of the very high profile components there. I think that, again, how big is the program going to be? If we were to deport net 2 million people and prevented new people from coming in, it would not be a good thing for real estate. Almost 85% of all immigrants coming in within 5 months get a job, and they help our job growth happen, and especially at places like hotels and agriculture. And so the president has said he might pull back some of the restrictions there. We'll have to wait and see what happens. Close to my heart, of course, is the attempt to defund university research in medical and science and academia generally. And of course, you saw all what they're trying to do with Harvard. They're threatening to remove its tax exempt status, threatening to prevent international students registering. But it affects a lot of our big universities and all our medical centers around the country. They've already slashed the NIH budget. And so many of the medical schools have big research operations, and it's affecting them quite negatively, and it's just beginning. But they're also slashing NASA, NSF, NOAA, HHS research, CDC. So it's a big deal for universities, academies, and the science profession. Again, why is it being done? Well, they say budgets, but the fact is it's a very small part of the federal budget. This is a much different agenda on their part. On the positive side, deregulation. They're making it easier to do M&A activities, and we're starting to see quite a bit of that happen. They've also changed strategy away from green energy to oil and gas. So that's leading to some drop in prices, which will help. Lastly, the Department of Government Efficiency wants to cut government employment. 75,000 government employees have taken early retirement, federal government early retirement, and we estimate another 200,000 may lose their jobs as we dissolve agencies, close AID, Voice of America, a whole bunch of things like that. So this is a big deal, especially in places that are like Washington, D.C., which have a heavy concentration of federal employment. Another big component of what they're trying to do is get this big, beautiful bill through the Senate and House compromise. It passed, this is extending the 2017 tax regime and adding to it reduction in taxes or exclusion of taxes for tips and overtime. I think it's depending on the version you look at, somewhere between 25,000 and 50,000 may be exempt from income taxes. They want to raise the state and local income tax deduction, and the cap now is $10,000 deduction. The House has passed a $40,000 cap. The Senate is negotiating. They're also going to put an excise tax on universities. The House bill on endowments. They proposed 21% tax in the House, 8% in the Senate. The tax rate presently is 1.4%. A whole bunch of other things happening, but let me just talk about housing policy for a minute. They proposed 40% reduction in the staffing at HUD and FHA. And as you know, or may not know, but between 60 and 80% of all single-family and multifamily housing mortgages go through these Fannie and Freddie. They've also talked about privatizing Fannie and Freddie. As you know, they were taken over by the government in 2008, and they're part of the government now, and they're public-private partnerships before that. They've talked about letting them go free. That probably raises mortgage rates, maybe by 25 or more basis points. On the positive side, the Secretary of HUD has talked about expanding and extending the Opportunity Zone tax benefits for investing in anything as well as real estate, but especially for real estate. And again, that has been a program that has encouraged quite a bit of new investment in inner cities, but it's not necessarily in weak zones. There depends on the lobbying that was done to get that in certain areas. So there's a lot going on, a lot of uncertainty. The tax law changes, of course, are the most important one. So where are we today? So tariffs are something that economists don't like. We've had a tariff level that's been very low, averaging about 2%, and the proposals could increase tariffs to a level that we haven't seen since the 1930s, over 20%. That's the proposals. That doesn't mean it's going to happen, but we'll know a lot more, I think, in the next few weeks or next few months. But it's created a lot of uncertainty. And again, import and exports are important. But why are they doing this? Well, the president has had a strong feeling for many, many years that we're being taken advantage of. And this just shows our trade balance in goods. And we have a $1.1 trillion deficit But it's been true that we've had a high deficit for the last 30 years. So it's a very big bee in his bonnet. And he has a trade advisor, Peter Navarro, who really wants to change this. What does this mean? Well, actually, it means that we get cheap goods from overseas. That's the big advantage. And the money is recycled with reinvestment of this excess back in the US. So economists love this idea of free trade and love the fact that we have a comparative advantage in some areas. In other areas, we take advantage of other countries. But if you look at it by country, the trade imbalance, that is, we import more than we export by $260 billion from China, 179 from Mexico, 160 from EU, 64 billion from Canada, I'm from Japan, and 35 from Canada. As an economist, this helps us. It keeps inflation down, and the money comes back as invested in U.S., whether it be real estate or other things, stock market. But this administration, led by Peter Navarro in terms of trade, wants these balances to be zero in each place. Now, remember, we also have a big surplus in services. And so that should be net of that. But even then, the idea that it should be zero with each country, very few economists believe that. Why does it matter? Well, we've already seen trade flows plunge from China. These are container vessels sailing. They're down dramatically in the last few months. And the dollar has also gotten weaker by 5 to 10% against various currencies. So in a way, that's something that makes, when we buy imported goods, it makes them more attractive. So we have to be selling our goods overseas, more attractive. So the trade stuff, economists don't like it, but the president is pushing this very strongly. We should get more information, hopefully in the next month. But let's be honest about it. It's being done out of ideology, not economics. We have 16% of our GDP comes from imports, holding down prices, and 11% of our income of our companies come from exports. So it's something that economists have always liked, free trade, but we're obviously moving to a very different environment going forward. So where are we today, and what does this all mean for real estate? Well, the economy and labor markets have been very resilient. We've had average of about 125,000 jobs a month created. In the last month, we had 139,000. Unemployment rate claims are going up, but consumer confidence has moved back up some. Inflation is under control. In fact, Chairman Powell, the chairman of the Fed, has said if it wasn't for all this stuff happening, the question is, for all this stuff happening, does it mean that maybe the Fed will start cutting interest rates? So that's something that everyone's waiting to hear about and see if that can happen. Real estate has actually done quite well. Credit in real estate is much more available. Banks and insurance companies and debt funds are aggressively trying to lend money in real estate. But the transaction volume is down by 40 to 50%, so they're not able to put the money out. But spreads have tightened, and we do have, especially in the office sector, older office buildings and Sunbelt apartments, delinquencies and defaults and foreclosures are up. But New York City, which is having a booming office market and apartment market, has seen spreads contract and financing readily available. So we have to be very careful. It's all by geography. So what do we think is going to happen? So we basically don't know. As many of you participated in my webcast in the past, I give you our base scenario, and we think that's the right one. But I think because of the tariffs, the immigration, the tax plans and spending plans, it's complicated. And of course, so we have a base case, which I still think is most likely, but it's only 40% chance. Any of you were at the webcast last year, we had that, I think it's 60 or 70% chance. What does it mean? It means job growth continues at a slower pace. The Fed cuts rates maybe twice more. So the short rate goes to 4, slightly under 4. The 10-year bond, which is roughly 430 today, settles in about 450. And we do get the spike of inflation temporarily from the tariffs. And this is what Chairman Powell has talked about. I think this is the Fed's base case. But we do think there's a chance of recession. And that recession risk comes from the instability created by the increase in inflation, the tariffs in particular, the immigration or deportation of individuals, and the cutbacks at our educational institutions, our hospitals, and government cutbacks, especially in Washington, D.C., but other state and local governments as well. In that scenario, there's I think, a silver lining. The Treasury bond drops from presently 4.30 to 3, and the Treasury bill rate, the Fed cuts aggressively to try to stem off or stop and slow the recession. But the worst case would be stagflation, and that is one that we don't want to happen, but that's a case where we get higher inflation, higher long-term interest rates. And we did have this happen in the late 70s, and it could happen again. So we hope that's not the case, but a lot of Wall Street people are worried that may be the case. Right now, we're in a sweet spot, but all these policies that are being talked about have not happened yet. They're about to be put in place over the next 6 months. And so far, we've seen not much, but we do think if we had the import restrictions, the trade tariffs, we could see construction costs up 5 to 10%, because we get aluminum and steel and lumber and gypsum. A lot of it is imported, and also labor shortage if we do get rid of a lot of the low-end labor that we need in the construction industry. Interest rates, I hate to say this, a wide range. It could be anywhere from 3% if we get a big recession, or over 5% if we get the stagflation scenario. That doesn't help you much, but I think you have to plan for uncertainty. Highest level of uncertainty we've seen since 2008, 9, and 10. So let's now go to a little bit more detail on what we think might be an opportunistic time, like we had in the early 90s, to be a real estate investor in new activity. And the early 90s, you may remember, was a period of distress, but also those years, 91, 92, 93, 94, 95, turned out to be the best investment time. You were able to buy below replacement cost for properties. And right now we have that true in office buildings, B and C office buildings. We have that true in multifamily and Sunbelt locations. You can buy at a discount from what it costs to build a new property. So what that means is you buy it, and then of course, if you can lease it up and the economy recovers and those sectors recover, you get a jump in rents and income. But we need to see capitulation by sellers and debt holders. And that is just beginning to happen. And I think that's going to be the opportunity. So it really is the second half of this year, and I think next year where that happens. But right now we have negative leverage from most types of real estate. What does that mean? That the cap rate that you're buying at, the income cap rate, is unfortunately below the debt rate. So you can't really leverage up and have a positive cash flow for many transactions. You can in certain types of real estate, certain locations. And the entry-level cap rates are 200 basis points higher than they were in 2022. So again, that's an opportunity. And we do think fundamentals will improve. The new tax law will go in place on January 1st of 2026, and supply and demand balance will be restored. Already we're seeing sharp drops in construction for apartments and industrial. Office, of course, is way down already. So that will help us restore equilibrium. And so the investments that one makes in the next year and a half, if properly done, could and probably will be very attractive. So the economy, to go through this very fast, we've added 6 million jobs since the bottom of the recession, which started with COVID. And last month we added 140,000 jobs. So the economy is doing well. That's about the right rate of increase to keep the unemployment rate stable. And the unemployment rate, as we see at the next slide, is 4.2%. That's the orange line, and that is full employment. and we're pretty much in the right range. So we have to watch this. If it starts going up substantially, then that's a sign that we might have a recession. But so far, so good. And if you look at the growth rate by cities, by metropolitan areas, the Sun Belt has grown pretty well and still growing pretty well. It's the oversupply that's made the problem there. So that is pretty attractive. The weakest place in job growth is still Northern California. Even though the real estate markets are beginning to recover, we still have job cuts taking place. So we analyze this city by city, and I know that many of you work in certain locations. One place to highlight, New York City has been red hot, but there's a mayor election coming up. The primaries last night led to a Democratic Socialist being the Democratic Socialist nominee, and he's in favor of zero rent increases, a number of other things, free healthcare, and also free bus travel. You can't do that in the big city, but the election is November, so we'll see what happens. The other big thing is immigration. Immigration has been the rock that has made our country so good. We've added 1.2 million people. That's the yellow line, the orange line per year, the last 2 decades. And we had the big asylum program, which let in 4 or 5 million extra people in the first 3 years of the last administration. That has been stopped completely, and we're having deportation. So this is a big deal, and it's, I think, ideological. It's not economic. What they're trying to do is they have undocumented individuals. They say they shouldn't be here. You see the ads on TV, and this is a big problem because we need these workers in construction and agriculture and restaurants, and we definitely will lose people and occupancy in apartments. And I think it would be bad for the economy if we do deport lots of people. Also, you can see it's pretty harsh. And the idea that the immigrants are criminals is completely untrue. The data do not show that. And so it's embarrassing that we're saying this, but you've got Stephen Miller as the prime proponent of this, pushing the president to do this. Inflation. So the inflation numbers are pretty good. They've dropped to below 3% in the mid-2s. And as Chairman Powell said, if it wasn't for several of these potential inflationary factors, tariffs being the big one, deportations being another one, he'd be cutting interest rates. But he's not willing to do that at this point any further until he sees the effects of these policies on inflation. Consumers are worried. Inflation expectations are the highest in a long time. And you can see goods inflation is not happening. Service inflation has come down a lot, and wage inflation has come down. So the outlook would be excellent if it wasn't for these possibly disruptive new ideas. Construction costs for the industry had a surge during COVID of about 30%, and they've been flat ever since, and maybe even a little bit of a decline. But if we do have this tariffs, we get a lot of materials from overseas, and if we have a shortage of labor because of the deportations, we might be seeing another increase of construction costs for real estate that's built. House prices have actually been mixed. In Sunbelt locations, they've actually declined. We have oversupply. So the average country house price is up 1.5% year over year. Strong activity in a number of markets, but at least half the country has house prices flat or declining. Overbuilding again. Home sales are weak. And the reason for this is the average mortgage rate is 6.5%, up from 3 to 4% just 3 years ago. So if you actually have to buy another house, you're going to pay a much higher rate. So people are waiting, and inventories are rising. Oil is a wild card here. And of course, oil prices have surged with the beginning of the Middle Eastern activity about 10 days ago. As of yesterday at ceasefire, oil prices have plunged back to the mid-60s. But again, energy is a big input, we have to hope that there's not again a resumption of war there or other disruptions to supply. Consumers felt a little better in May, but basically they're depressed. They've been depressed because of COVID and depressed because of the rising rates and higher inflation numbers that affected them during COVID and haven't reversed. So we have a situation where rents are up 20 to 40% for apartments compared to where they were before COVID. That's a big number for the renters. And remember, a third of the population rents. Food prices up 20%. So all of this has created, again, somewhat depressed consumer confidence. Auto loan delinquencies are near recession levels. Credit card delinquencies are rising. So there are signs that the lower third of the population is being stressed. And interest rates have come down on the short end by 100 basis points, but the long bond is still sticking there at about 430. So unlike the last 15 years where rates on the long bond averaged 2%, they have doubled that now, and that means mortgage rates are double. And the short rate also is up substantially from where it was. So the easy money that we had for the last 15 years, at least for the last 2 years, is over. As you know, the president is pushing the Fed to lower rates. Powell has said he's not going to do that. But I think if the economy gets weak, he will do it. He just doesn't want to be pressured by the president. And the other part of monetary policy that is affecting the economy, beginning in 2008, for the first time in our history, we had what we call quantitative easing. The balance sheet of the Fed went from 1 trillion to 4.5 trillion. And then when COVID struck, it went to 9 trillion. What this has done is push money into the banking system to alleviate the recessions. But now we have quantitative tightening. We've moved from a $9 trillion balance sheet to 6.6. The Fed is reducing its bond portfolio by only $5 billion a month versus a much higher level earlier. So I think that money is available in a fairly good way today. But again, the Fed is about done with quantitative tightening. So the last thing to mention on macro policy before we get to the real estate side, which you're all waiting for, I know, is we have a huge deficit. Almost 1.9 trillion last year. If this big, great, beautiful bill passes, we estimate, and others are talking about, somewhere between 2 and 2.5 trillion. That is, as you see, 6 to 8% of GDP, and it's just unacceptable. Bad policy on the part of Congress, on the president. The last time we had a budget surplus was under Bill Clinton. So this is putting pressure on the borrowing costs that we're all facing. And that is why we're worried about the higher deficits, creating the 10-year bond not coming down and might even go up. And it shows up in something called the real rate of interest. This is a TIPS bond. You get paid this rate plus a CPI adjustment. 2% is the average over the last 100 years. But the last 15 years, we averaged under 1% and 2 periods with negative rates. So money was very cheap, and real estate professionals made 1/2 to 1/3 of their money on the spread between cap rates and interest rates. That is no longer true, and we don't think it's going to be true going forward. So you have to make the money the old-fashioned way: leasing, rent growth, development. It's not going to be easy to get that spread. I hope I'm wrong. I hope rates come back down lower, but we don't think they will. So our forecast on rates is the 10-year bond. You can see we have under 3 scenarios. The forward curve, which is the market's expectation, has rates coming down to a little bit below 4% on the 10-year bond, and that, of course, affects the mortgage rates directly. Stagflation, the red line, shows that rates going up, and almost no one wants to believe this, but that's what would happen. And then if we get a deep recession, rates come down. They come down to 3% on the 10-year Treasury. they do not come back to the 1 and 2s, which we were at during the COVID period. So we want people to give us their views of what might happen. Your forecast of the 10-year bond. I'll turn this over to Cole to moderate this.
Thanks, Ken. For our second CP polling question, we have, what is your forecast for the 10-year Treasury bond interest rate at the end of 2025? A, under 3%, B, 3 to 4%, C, 4 to 5%, or D, over 5%. And as you take the time to answer the second CP polling question, as a reminder, if you would like to receive CP credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. And for reference, again, this is the second polling question. Give it about 5 more seconds. And the question is now closed. Back to you, Ken.
So I think you can see from the poll that most people think rates are going to edge down a little bit, but there are significant numbers who also think it's going to stay where it is, 4 to 5%. Very few of you think it's going to go higher, over 5. And I think that's the risk for real estate. And a few of you, 15%, think it's going to go below 3. And we have the next one, what people think about the economy. So Cole?
Thank you, Ken. For our third CP polling question, we have, what is your forecast for economic growth in 2025? A, shallow recession, B, stagflation, C, moderate growth, or D, not sure. And while you take the time to answer our third polling question, I just want to remind the audience that due to the proprietary nature of the slide deck today, we will not be sharing it for this webcast. However, a recording of the webcast will be sent to you after the end time. Give it about 5 more seconds. And the question is now closed. Back to you, Ken.
So just to show this, about 60% of you, which is our percentage as well, think we have a shallow recession or stagflation. You're almost identical to what we're thinking. And again, about a quarter of you think the growth will continue at a moderate rate. So you agree with us. I hope we get the moderate growth. We all want that. So one more thing, and then I'm going to go to real estate in detail. Why is inflation going to stay elevated? Well, the big thing is demographics. We have an aging population in the US, Europe, Japan, and China. That means chronic labor shortages unless we let a lot of immigrants in, and no one seems to want to do that. We also have free trade ending. We have tariffs. We have security and geopolitical concerns, trade barriers, protectionist measures. And that's going to put inflation back on the track again. Decarbonization might be suspended. Certainly in the US, we're going back to oil and gas. And that actually could ease inflationary pressures. And then defense spending, you probably read, NATO all wants to get to 5% of GDP on defense. More money going to arms, more wars, hopefully not. But the worry is if defense spending is putting money in the ground, it doesn't help the consumer investment needs. And of course, the deficits we all talked about already. So let's talk about real estate in detail. First of all, money. There's quite a bit of money available. CMBS market is having its strongest year since 2007. And that's 118 billion annualized so far. The blue line is the spreads, and spreads are about where they were just a decade ago. So real estate financing is available, but transaction volume is down. So its volumes aren't as strong as they could be. We also have a lot of maturities taking place, that loans that were made 2 and 3 years ago are maturing and have to be refinanced. And that's the problem. For 2 big sectors, the office sector, huge surge in delinquencies, and then the apartment sector, also a big increase in delinquencies. But as investors, that's an opportunity. you might be able to buy stuff, and you will be, at discount to replacement cost, especially in B and C office and apartments in Sunbelt locations. But again, is the demand there to help the return? Cap rates, again, this is institutional cap rates, but for apartments, they're running somewhere between 4.5 and 5.5 for the best quality stuff, surprisingly low. And that's why the negative leverage is happening. And industrial, maybe 50 basis points higher in the very high fours and through the mid fives. Office and retail cap rates are much higher. Outlook is more problematic. But again, it depends on the property, the leasing, and of course, the quality of the property. So be careful, but they're a little better initial return. And the return numbers we have through the first quarter of this year, and the strongest sector is actually retail. Retail, if you look at the orange line there, is up 6.5% total return. Hotels also up. Both industrial and apartments, because of the oversupply in Sunbelt locations, are seeing positive returns, but not even any real appreciation. And office, unfortunately, still write-downs taking place. But again, AAA office are doing quite well. And so we look at a cycle here. Where are we in the clocks? So A and B, A minus and B plus and C office, and it's really struggling. Occupancy is just not returned to pre-COVID levels. And of course, the malls, B and C malls, are struggling. Life science especially struggling, and this is before the big cutbacks of federal funding. Already vacancy rates are 20-25%. And self-storage is also overbuilt. But the other product types are what I call modestly correcting. They're a little bit overshooting, whether it be Sunbelt and Mountain State apartments, rents are going down, values are down. We have the same thing true for other product types as well. But most product types are in the small amount of overshooting, which will be resolved over the next several years. But you not need to do this analysis, but when we do it by market and by class of property, that's what we do for a living. The one sector that everyone wants is data centers. And again, lots of money pouring into that sector for new construction. So I'll take you through each sector. We've got about 10 more minutes of this before questions. Apartments and single-family rental are still our favorite product type. However, the Sunbelt and Mountain States have overbuilding. So it could take somewhere between 1 and 2 or even 3 years to get back to equilibrium. Coastal markets are seeing NOIs go up substantially, very low levels of new construction. Single and family rental is a new asset class. Many of you probably have a few, but it's also institutional now, doing quite well. And new construction for multifamily is plunging. It's down 50-60%, and that will help things improve. But it takes time. And that is something a lot of people don't like. A third of all Americans, 35%, are renters. So it's a very big sector of the economy. And because rents are down in all the Sunbelt locations and have not gone up much in Northern California for 5 years, affordability is a little bit better. But we still have a third of young adults living with their parents. They're not renting. And we need them to get them out of the house and become renters. And that's elevated since the Great Recession. It has really not come back down much. We also have a lot of people turning age 18, and that's when they begin to look at themselves out of their house into rental market. The biggest growth, though, coming in the next 5 years is retirement. The baby boomers are going to be retiring, and senior housing is going to be very attractive. So the baby boomers, which were born from 1946 to 1961, that's the big demographic strength, and that's the demand. Also, 35 to 44-year-olds are staying as renters longer. Even the young group is still growing. And we have very strong household formations, some of the strongest we've seen. And if we can go back one slide, see if I can get to have us. New supply is plunged. New supply is plunging. and even the 200,000 may be too high. So that's going to get the markets back to equilibrium. Not quickly, but happening. But as a result of the new construction, vacancy rates are up to 5.2% for investment grade properties, 8.2 for workforce housing. And we had the rent spike in the COVID area. That's over. Rents are growing about 1% a year at the moment. But this is very interesting. We chart this every month. And the places where we're not building and economies are pretty good are showing real big rent increases. Manhattan up 8.6% year over year. Silicon Valley, San Francisco, actually first positive rent growth in a long time. And at the bottom of the chart are all the Sunbelt cities where rents are declining. And I say effective rent because you get free rent, rents themselves may be down, free rent, and we have weak occupancy. So it's a very bifurcated market. And as investors, that's the way you have to think. Again, if you look at over the last 5 years, rents are up 20 to 50% in all the Sunbelt markets and most major markets. The exception is Northern California. Rents are up a little bit and, of course, have been weak. And so they have a long way to go to catch up every place else, but they're trying their best to do that now. And returns have been great over the long run in apartments, but we've obviously, with COVID doubling up, we had negative returns. They're positive again. Senior housing, again, an area, if you looked at demographics, looked like it's about to break out as a major positive investment environment. And single family rentals, again, very positive environment today. Vacancy rates are low and rents are stable. So I now want to conclude with office. Office, we've got a problem, and that is the hybrid work model. People don't want to return to the office as they should. The AAA buildings are doing great, but the B and C buildings are not. We don't have much construction, so that's not the issue. The issue is job growth has not been strong in the office sector, but the real issue is this. A third of people want to live and work in the same place. They want to work from home. That's the orange line. And as we say at our job, FIRED, you're going to work at home, you're not working. Also, employers want you in 5 days a week. So the absolute numbers are 3 to 4 days a week for most employees. And we went too fast here. We can show you that places like New York, they're back in the office. New York is full. But San Francisco, we still are, half the people are not coming in. They're coming in maybe 2 or 3 days a week. New York, you're back. And big companies like JP Morgan, Amazon, they want you back every day. As a result of this, we have a lot of sublet space available. We have the highest vacancy rates in modern history for CBDs, 23.6%, and for suburban, 21%. So this is a big problem for the office sector, for the B and C office, even A- buildings. And some are being converted to apartments. It's starting to happen very slowly, but we think it might really be a big trend for the older buildings that have the right footprint to convert to apartments, where we have very strong demand. And then finally, returns to office, unfortunately, has been negative. And again, the AAAs are special, but other product types haven't done as well. We just have a couple of more slides. Retail is back. We all know that there was a huge surge in demand from e-commerce. And just to show you the numbers, e-commerce is growing, but much more slowly. It was growing double digits. It's now 6%. Brick and mortar growing 3.8%. People want to shop. They want that experience, and it shows up in the data. So that is something that we think is exciting. Vacancy rates on the retail that hasn't been put out of business is very tight. And so retail is the best performing sector today. It's complicated. You're leasing to many different shops. It's not an easy process to do. And returns are the best in a sector. Finally, hotels, occupancy rates have come back, but are still below the peak. but the ADR has surged. Very little new construction in hotels. People are traveling, maybe a little bit less, but you can see that red line there. Occupancy is not at its peak, and this chart just shows you exactly where we are. ADRs are up, especially at the high end, and overall, we have an improvement in the RevPAR, modest improvement. Again, pretty good performance in the hotel sector. So let me conclude with one more question. So Cole?
Thanks, Ken. For our final CPE polling question we have, what is your view on the best property type for investment in 2025 to 2026? A, office, B, apartments, C, industrial, or D, retail? While you take the time to answer our final polling question, once you have completed all CPE requirements, you will be able to download a PDF of your CPE certificate from the CPE progress window. We'll give it about 5 more seconds. And our final CP question is now closed. Back to you, Ken.
So again, we can see apartments are the favorite choice, my favorite choice. Retail, industrial, about the same. And people aren't comfortable with office yet, except maybe for the AAA component. So let me just conclude with a final slide. We think it's a good time to be looking at acquisitions. Hard to do new development, but debt is very attractive. You get nice yields and you can underwrite pretty carefully. The REITs are up about 30% from their bottom, but they're still probably 15 to 20% below their net asset value. So a lot of people are doing structured deals, rescue capital. I still think there's a chance that we could see the spike in inflation. So you want to do a hedge. I think if you're financing, banks require that in many cases. But if you're older in the 60s and 70s, now maybe be the time to try to harvest your assets through a 1031 exchange, through an upgrade transaction, so you don't pay any capital gains taxes. The guys on Baker Tilly can do a great job helping you structure those deals. And development is going to take place again in the markets where supply and demand are in balance. And over the next several years, we expect that to happen. But there's still a chance, and I'd say a 60% chance, of either the stagflation or recession scenario. So you've got to keep your powder dry and get ready. So we now have time. I'm going to turn it to Kelvin. We've got time for some questions.
Yeah, Ken, thanks for all the information here. One question around, single family home supply, and, talking to our land developers and clients in the single family space, it seems like that's been one of the biggest roller coasters the last 5 years. Do you have any data or just thoughts around supply of new single family and existing single family homes on the market? Seems like existing is kind of building.
Yeah, so it's really mortgage rates that have done this. People who have an existing mortgage and under a 4% are very reluctant to trade up and take a 6.5% or 7% mortgage. So resales have been depressed. New construction is running about 1 million housing units a year, but the home builders are seeing big buildup in inventories in many markets, especially the Sun Belt, and they're having to discount and provide incentives. So I'm afraid that unless mortgage rates come down, we're going to see that market still stagnate. And if you can stretch and buy something at 6.5, I think you'll be happy, but you can also bargain pretty aggressively in many markets on price.
Here's an interesting question, at least I like, is, we talk about all the uncertainties in your presentation that's happening today. Has there ever been a period of time where you've been certain about the economic outcomes?
So that's a good question. The answer is yes. Every time we've had these big recessions, if you take what I would call a contrarian approach, you will make money. The biggest one was the early 90s, again, early parts of 2001, 2, and 3, and 4. And the same thing would be true in 2009, 10, 11. So after a big downturn, if you have patience and have the financial wherewithal, that's when you make the big money in real estate. This has been a very unusual period because we have some dramatic changes in fundamentals, whether it be tariffs, immigration policy, tax laws, a lot of it more uncertainty than normal. But we've seen already the response: oversupply in apartments, in Sunbelt locations, and industrial, and the market adjusts pretty quickly. But you have to have patience and staying power to make the things today. And transaction volume is down dramatically for almost everything. So I think if you've got the staying power and the analysis behind you, I think it's a great time to be an investor, but carefully.
What is I mean, I always am interested in, again, going back for 5 years, a lot of migrations of actually people moving to the mountain states and other, Sun Belt, also headquarters moving out of the high cost states. What's your data showing as far as is the company and or migrations, headquarters migrating and people migration still pretty active, or do you see that slowing down?
So part of the surge in the last 5 years was COVID related, that basically people didn't have to be in the very dense locations. So we had quite a few people move out. That's reversing to some extent today. Apartment vacancy rates are very tight in Manhattan, very tight in San Francisco. So the coastal markets, which lost population, people have come back who lived there before. But we do have the fundamental problem of taxes. Taxes in California are high, some of the highest in the country. Same thing is true in New York. And we have basically those economies have a problem of affordability. And the main reason people move and companies move is they can basically have a more affordable cost of doing business in Texas, Florida, even though Florida's gone up quite a bit. So that is why California and New York and the Northeast generally has suffered. Weather also, aging population. People want to be in a warmer climate, even though I'm in New York at the moment. It may be a little bit too warm at 98 degrees. But I think climate change also is affecting that. So I think I'm still a believer in outmigration to the Sun Belt and unfortunately slow growth in our older coastal cities.
Switching topics slightly, a lot of news being coming out about the impact of artificial intelligence, robotics. Are you starting to see any data come out yet that people could take as a takeaway around the impacts of AI and robotics on the real estate industry?
So I think there's no question that in both East and West Coast, there's a surge in leasing by AI companies and a lot of money being invested in data centers. We're talking about hundreds of billions of dollars to accommodate AI. Is it going to be a revolution where we take a lot of jobs out, or will it just be a productivity enhancer like the internet? I don't know the answer, but every one of our clients is focused on getting more efficient. And AI certainly can help. Copilot is one of the used. Claude, there's a whole bunch of them. But we're waiting to see the applications where the breakthroughs will really happen. Right now, it's the data centers and the beginning of AI assistance. But we have a ways to go to know the true answer. Is it going to be the internet or something more robust?
And speaking of data centers, obviously there's going to be a big demand for more today and going forward. But you also hear about the level of energy needs that they have. what are your thoughts around just the ability to get enough energy to be able to develop the data centers that are needed?
So that is the big constraint. We just don't have enough energy. So in many cases, you have to wait 2 or 3 years to get connected. So many of the data centers are being built in places where there is excess energy. But energy is the constraint. Matter of fact, they don't even quote rents. They quote it in kilowatt hours rents. They don't quote it in real estate rents. So I think it's the hottest area for almost every one of our clients, but they're big projects. If you've got some of the big companies like Amazon, Google, Salesforce, Microsoft as your tenants, that's great. But I'm worried that we're going to overbuild as we did life sciences. The same thing might happen, but the energy constraint may save us here.
Well, Ken, we are at our time. Thank you very much for your insights and commentary. Cole, back to you. Thanks, everybody, for attending.
Thank you, Ken and Kelvin, for a great presentation today. If we didn't have time to answer your questions, we will do our best to follow up with you after the webcast. As a reminder, if you attended today's presentation in a group and would like to receive CPU credit, you must complete the group form located in the slide deck and handouts window. If you participate as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy of your CPE certificate will be emailed within 3 weeks should you have any difficulty downloading it now. And finally, here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Also, please keep in the loop for future webcasts and other resources to help elevate your performance on our website. Thank you for joining us, and we hope you'll see us again next time. Take care. Bye.
Kill it.